Roughly 2 months ago, I floated the idea that Tencent might potentially be ready to go to 600 Hong Kong dollars per share. And from that upload, we have actually seen Tencent starting to flirt with that 600 Hong Kong dollars territory. And the natural question is, what transpired? And in my own personal opinion, I do believe that the most recent quarterly earnings was the main culprit, or in this case, the main justification, where the market is coming together to ascribe a premium valuation to this business again. So in this video specifically, we're going to cover two main topics. Firstly, it's of course the breakdown, my own personal findings and interpretation of their most recent quarterly earnings. And secondly, it's about the stock itself and what role it plays in my portfolio and why do I still feel tempted into adding it despite it being my second largest position. But for those of you that are very strapped on time and you need a TLDW, too long didn't watch, all you need to do is to internalize this sentence from their most recent disclosure. Revenues from their marketing services were 35.8 billion, up 20% year on year. And this growth was primarily due to AI-driven improvements. And thank you very much for watching my video. And this earnings can be summarized in 3 words. AI is real. But jokes aside, before we dive deeper into their most recent quarterly earnings, full disclosure, these are where my biases are. Tencent is already my second largest position. I do have an average cost of roughly $343 per share, and I'm sitting on around a 72% unrealized gains. So take it as how it is. I do believe that everybody will have different interpretations and understanding of the business with a different cost price as well. But let's try to take a more objective lens into looking at the business today. So like any earnings disclosure, this was the financial highlights breakdown of Tencent, and you can see that top line revenue actually grew 15% year on year, and the major breakdowns include their value-added services, marketing, and fintech, with marketing services and value-added services leading the pack. And when you look at the bottom line, both gross and operating profits increased at a faster pace compared to total revenue, suggesting some sort of a leverage kicking in. So do you know that the $2,000 sitting in your bank account today could be working way harder for you? And Longbridge, a MAS licensed broker in Singapore, has a promotion running right now. And if you sign up with my link below and deposit just 2,000 Singapore dollars, here's what you get. A 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up and you're looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong, and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. Now, if to dive deeper and to look into their earnings deck, you can see multiple footprints of AI. And it feels to me like the management team is quite afraid that investors don't know that they're engaged in many of these artificial intelligence developments. So they talk about AI features updates in Weixin, which is the main chatting, messaging, social media platform in China today. So they added AI-powered citations to content. They enabled users to activate contextual commentaries. They used some sort of LLM capabilities to provide more intelligent responses. In fact, it doesn't stop there. AI is also contributing and enriching the games by accelerating their content production speed and scale. They're also helping to enhance marketing for player acquisition and engagement. And of course, most importantly, when you're trying to bridge the AI development with real earnings numbers, they actually cited that for their marketing revenue, they grew 20% year on year, directly benefiting from the AI-powered ad tech upgrades and a more closed-loop advertising activity. So all things considered, I think it's safe to say that the management team is not shying away from this AI term, and in fact, they're basically just love bombing investors, telling us how good AI is, and they're probably the next best thing after sliced bread. If you couple the presentation deck with the earnings call discussion with analysts, here was what management had to say. So reviewing the progress of their games business domestically and internationally in recent months, AI has become an increasingly important driver of its growth in terms of game content, game engagement, and game monetization. So not so much just in terms of the fulfillment and supply side. It's also a lot in terms of their marketing, in terms of their engagement and their retention, and all these very important metrics for the gaming division alone. And in fact, AI has also allowed us to provide more human-like virtual teammates in our competitive PvP games. And we're using AI in our game marketing activities to more efficiently target marketing spending towards the users most likely to activate and remain in each game. And this is pretty much changing the business game itself. No pun intended. And really, I'm just taking a bird's eye view into looking at Tencent's business over the last 3 years. It's safe to say that they're at peak performance. So peak gross margins for value-added services, a small 10 basis point miss from their all-time high for their marketing services, and peak margins for fintech as well. And even if you want to try to pinpoint in terms of their cost control, yes, R&D is growing at a faster rate compared to revenue top-line growth, but both sales and marketing and general and admin expenses actually grew slower. And in fact, to drive that top-line 15% growth, their sales and marketing only grew 3% year-on-year. So tell me more about how you wouldn't like such a business. And another recurring theme, especially in this dawn of an AI era, around many of these tech companies, is the consistent crazy amount of spending and commitment around the AI infrastructure on chips, on data centers, or just down to the training or inference of the large language models. I think Tencent is no stranger to this development, and in fact, you can see that the operating capital expenditure is up 149% year-on-year. But that doesn't mean that they're all operating with the same strategy of evaporating free cash flow. In fact, Tencent's free cash flow for this latest quarter still grew 7% year-on-year, despite this crazy increase in capital expenditure. And this spending is actually largely cushioned by also a lockstep increase in their operating cash flow. And it is probably one of the key factors of why it makes Tencent stand out from the crowd. So when trying to assess the broader overall AI strategy of Tencent's business, this was what management had to say. And I quote, "Well, in terms of the AI spending right now, I would have to say we have been spending quite a bit. And we are also increasing our spending, and we'll be spending more as we go along. So that's sort of already happening. But at the same time, we also have to be spending smartly, rather than just sort of saying, oh, we're going to go all in and spend on buying a lot of chips and hiring a lot of people and doing a lot of marketing, right? I think we have to sort of spend in the right tempo. So with respect to our capex target, we have not revised our full year target yet. And when you talk about the impacts on the group margins, I would say that the depreciation costs related to AI will definitely continue to go up. But at the same time, we also see that we continue to reap the benefits of AI. And the issue is that these two may not match each other completely, but I think both of them will be moving in the same general directions. And I believe for those of you that are very in tune in the Chinese AI tech space, I think shots are fired. You probably know which company is embodying a completely different AI strategy from Tencent. But I think nuances are important here. Clearly, I think Tencent here is not going towards the cloud AI infrastructure play. They are not looking towards building the leading AI infra, leading AI model, but more so the emphasis is on their core business and how they can monetize well. So that means that they can be a lot more prudent and a lot more strategic in terms of their capital allocation decisions. And in fact, in this most recent quarterly earnings, there were 3 under-the-radar discovery or interpretation on my part, which we'll talk more about later. But I think on the surface level, clearly it was not about AI, because they made it explicitly clear throughout the entire messaging. But they did leave many clues of further monetization and how they table the costings of these developments in the coming quarters or years ahead. So the first under-the-radar comment for investors that missed the earnings call completely was that their ad platform today is severely under-monetized, and they can double or even triple it easily. And here's what they replied to analysts when they were asking about their entire ad business. And I quote, "And then finally, in ad load, where, as you know, for short video, our ad load is currently in the low to mid-single digits versus our peers who are in the low to mid-teens. So those are the reasons we believe there's a long runway for growth for our advertising revenue." So in terms of prioritizing between the drivers, the majority of the advertising revenue growth of 20% year-on-year arose from higher revenue per impression. And that was primarily due to a higher click-through rate arising from deploying AI, although also to higher revenue per click arising for a more closed-loop activity with mini-shops and mini-games, unquote. So I believe the underlying message is pretty simple. I think there's two main points. Firstly, when comparing to their competitors, at least in this very nascent short-form video monetization space, people are monetizing at an ad load of 10-15%, we are doing it at roughly 5%. So we can double and triple it easily without shortchanging their customers and how best to implement it. And I think the second message here is more so about the strength of their economic moat. They are telling you that there are a lot of levers to pull for growth, but they are not maximizing opportunities yet. So there are probably different considerations at play here, but the messaging here is simple. Just by deploying AI, we were able to grow our advertising revenue growth by 20% year on year. Think about what happens at the end game where we actually pull and maximize all levers. And the takeaway is that we are still early in this advertising growth curve. And the second under the radar comment was that they reminded us of the difference in dynamics between discovery content and search content. And don't worry, the current AI assisted requests or searches that are being performed in the grander ecosystem of content is nowhere near even disrupting Tencent's current content ecosystem. And this was what they had to say, and I quote, "In terms of whether it's really going to hurt the search, I think the one sort of negative impact that you are pointing to is when there is AI-assisted search, whether it would be just to show the content rather than leading people to the pages. We have not seen a very big impact on that. And I think overall, people tend to be more satisfied in getting the answers directly. And if they want to explore the topics more, they would click on the different links and articles. So I think overall, it's actually not that much of an impact. And at the same time, if you look at the ecosystem within WeChat, the content ecosystem, a lot of page views is actually from non-search related origins. So when people subscribe to a writer's content, most of the viewership is actually based on merits or points. So in terms of the impact on specific authors, I think the impact is minimal at this point in time. So the general gist here is that they wanted to remind people that WeChat is not competing with Baidu or not competing with the likes of Google, where the main monetization model revolves around search. And with a more clearer emphasis of discovery algorithm, probably brings in more usage, more attention, and more spend time on the Tencent ecosystem platform itself. Which then leads back to the point on why Tencent is so uniquely positioned in this new AI growth curve. And the third point was that Tencent's spending strategy in this AI wave is completely different from the technology company's consensus. And I might argue that it's exactly because they operate from a position of strength, which enables them to be much more chill or relaxed in this AI development cycle. And they're basically flexing the strength of their moat. Yes, they might not be the largest cloud platform, they might not be the largest infra player, they might not own the best, most cutting-edge LLM model, but the main point is they don't need to. In terms of your question about the cost, I think we are actually managing the cost in a relatively granular way. I think there are a lot of places in which if we can use a smaller model, we'll be using smaller models and the cost will be sort of much lower than using the flagship model. And at the same time, we also have to be spending smartly rather than sort of saying we are going all in and buying a lot of chips. From their own perspective, they said that we do have enough chips for training and continuous upgrade of our existing models. And we also have many options for inference chips. And we are also executing a lot of software improvements and upgrades in order to drive efficiency gains in inference. And we can actually put on more workload with the same number of chips. And in particular, right now, they are in the process of figuring out the optimal product offering and use case. So before we do that, I don't think we should be piling in on marketing expenses for that product itself. And when asked about their GPU usage and building out their entire cloud computing division, and here was the management team's very nonchalant response. So if we do have sufficient GPUs that we can rent out more in the cloud, then we'll do so. But our cloud strategy is not dependent on the GPUs. We are also growing in CPUs, in storage, in database, in CDN, and so forth. So that's on the cloud side. And clearly, when their competitors are zigging, they're zagging. And to tie everything together, I think especially to the mantra of Tencent's execution and their ethos, they are always focused in terms of the runway for growth. They want to be a sustainable business and they want to look towards how they can generate utility, not only for the customers, but also for their shareholders and for their own team itself. And I think compared to their 2022 lows, at least in the last 3 years, this recent earnings has got to be one of the most encouraging and upbeat earnings numbers and commentary from the company. So they're very calm. Their attention is not being snatched away by all the different headline news. They continue to put their head down and execute and fire on all cylinders. And from an investor perspective, I think it'll probably be a classic case of you asking yourself, why didn't I buy more at XXX price? But I think to really answer one of the most important questions on most investors' mind today, probably constantly asking yourself, what should you do with the stock? Where do you go from here? Do you buy more? Do you hold? Do you sell to lock in your profits before a Chinese tech homecoming comes again? But to float some of the numbers out there, looking at Tencent's valuations today, even after this run up, so they're currently trading at roughly 600 Hong Kong dollars per share at a 700 billion US dollar market cap. And for long-time viewers, you will know that I have a long-term price target of at least 1,000 Hong Kong dollars per share for Tencent's business. So that's at least another 69% increase from here. And that's not intentional. That's around a 1.2 trillion US dollar market cap. And the CAGR, which is the compounded annual growth rate for Tencent as the stock, if they're able to hit this 1,000 Hong Kong dollars price target within 3 years, is 18.5%, 13.6%, and 10.7% for 2028, 2029 and 2030. And the current earnings per share for Tencent is roughly 24 Hong Kong dollars per share. And assuming that if we to ascribe a 25 times price to earnings multiple, and they need to hit a 40 Hong Kong dollars earnings per share, and the natural question is, how fast does the earnings per share needs to grow in order for you to see this share price appreciation? And you can see that they exactly match the numbers that we talked about previously. And why? Because the current earnings multiple is around the same here at 23, 24 times. So assuming that you hold PE multiple the same, earnings has to grow in lockstep for you to deliver that kind of share price appreciation performance. And right now, the consensus estimates on Wall Street is that EPS for Tencent is expected to grow between 12 to 15% in the next 3 years. And assuming that they do hold their PE multiple, and if the earnings is going to be reflected very cleanly in the income statement, and the share price is actually growing in lockstep, you basically assume all else equal, it will be translated to your portfolio CAGR too. And of course, not forgetting a few other tailwinds behind the business itself, a better operationalization, increasing margins, and by translation, increasing earnings, potentially another round of PE multiple expansion again. And of course, last but not least, I'm not forgetting to smash the like button if you've already watched until the end of the video. With that in mind, do feel free to leave in the comment section down below on what you think of Tencent's most recent quarterly earnings. Do you have a position in them in your current portfolio? For myself, yes, even though it's the second largest stock position, I am tempted to actually increase my exposure. But my considerations right now are more so from a portfolio allocation perspective. And I actually don't mind adding more because I do have a much lower cost price. For those of you that are just entering as your first starter position, it might not have the expected margin of safety, even though I still remain very bullish for the business itself. So with that in mind, I'll see you in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye.